Second part, international money market. So the biggest, the most core market, international money market, is the euro currency market. And what is the euro currency? It's a time deposit in an international bank located in a country different than the country that issued the currency. So it's not just a European currency. So for example, Eurodollar is the dollar, US dollar denominated time deposit in bank located other than the United States. Euro yen denominated time deposit in a bank located other than Japan. So this foreign bank does not have to be in Europe. This euro is not about Europe, okay? So most euro currency transactions are interbank transaction. So this transaction is sizable, precise, size-wise is big, in the amount of the million and up. Billion and up. So there's common reference interest rate. There's a LIBOR, PIBOR, CIBOR, like a LIBOR, PIBOR, CIBOR, whatever you pronounce, depending on where you live. You know, so United States, many people just pronounce LIBOR, PIBOR, CIBOR. In Europe, mostly pronounced like LIBOR, PIBOR, CIBOR. And LIBOR is London Interbank Offered Rate. The PIBOR is the Paris Interbank Offered Rate, and CIBOR is the Singapore Interbank Offered Rate. So basically, it's all interbank interest rate, and just in different market, London, Paris, and Singapore. Now, usually the LIBOR is probably the most commonly used reference rate. Now, there's some new reference rate from the euro currencies, because the euro is now, like, it's not really new. It's about 20, actually more than 20 years ago. But still, like comparing with other currencies, it's relatively new. It's called Euribor. It's the rate at which interbank time deposit of euro offered by one prime bank to another. So Eurocredit. Eurocredits are short-term or medium-term loans of these euro currencies. The loans are denominated in currency other than the home currency of the euro bank. So like the US dollar in London from the UK bank. That's probably typical one, right? That's euro dollar loans. The loans are too large for one bank to underwrite. So many banks form syndicates to share the risk. Eurocredit use the adjustable rate, usually based on the LIBOR. Many cases, reference rate, mostly LIBOR. London Interbank Offer Rate. For the rate arrangement, so there's interbank contract that involve two parties, buyers and sellers. The major risk Eurobank may face in accepting this euro deposit and extending your credit is interest rate risk, resulting from a mismatch in the maturities of the deposit and credit. And this is very typical for many banks. Example, if deposit maturities are longer than the credit maturities, the deposit and credit, so deposit, you actually are liable to pay this deposit. Credit, you should receive that, right? And interest rate falls, what happens is the credit rate will be adjusted downward, right? Because they use the adjustable rate, while the bank is still paying a higher rate on deposit usually. Conversely, if deposit matures are shorter than credit matures, the interest rate rise, deposit rates will be adjusted upward while the bank is still receiving a lower rate on credit. So only when deposit and credit maturities are perfectly matched will the rollover these features of Eurocredits allow the banks to earn the desired deposit loan rate spread, because this deposit loan rate spread is the major source of income for the bank, right? So to hedge against this risk, they use the forward contract. The buyer agrees to pay the seller the increased interest rate costs on the notational amounts if interest rate fall below an agreed rate. So it's kinds of, I mean, we already see the forward contracts between two parties, right? It's very typical way. The seller agreed to pay the buyer the increased interest cost if interest rate increases above the agreed rate. So there's a forward contract they use. So this forward rate agreement, usually referred as FRA actually, FRA. It may be used to hedge asset the bank currently owns against interest rate risk, okay? So there's an example here in the slide. A bank that has made a 3-month Eurodollar loan against the offsetting 6-month Eurodollar deposit could protect itself by selling what? A 3 against 6 FRA, okay? So there's some kinds of the forward contract that you can set to hedge. But you can also use as a speculative way, so speculate on the future course of interest rate. So you want to make money from your expectation, then you can actually bet on this speculation. There will be more detailed example in textbook. So if you're interested in this forward rate agreement, then you can go to textbook and read the case. Euronotes. Euronotes are short-term loans, short-term notes underwritten by who? The group of international investment banks, syndicate, or international commercial banks. So they form a syndicate called the facilities. A client borrower makes an agreement with a facility to issue euro notes in its own name for a period of time, generally 3 to 10 years. I mean, euro notes are sold at a discount from face value and pay back in the full face value and maturity. So this is a 0 coupon bond, usually euro notes, and typically the 3 to 6 months. Okay. Borrowers find these euro notes attractive. Why? Because the interest expense usually slightly less, typically LIBOR plus some percentage points, comparing its syndicated euro bank loans. Okay. For banker side, it's attractive too because they earn small fees from the underwriting or supply the funds and earn interest. Okay. So they set a facility. They usually keep the facility about 3 to 10 years, and they issue the notes maturing in 3 to 6 months. It's called a Euronotes. Eurocommercial paper is similar to the domestic commercial paper. CP, commercial paper is a CP. It's unsecured short-term promissory notes issued by a corporation or a bank and placed directly with an investment public through a dealer. Eurocommercial paper is sold at a discount form from face value. Maturity range usually 1 to 6 months. So it's very short-term loans, like all SCP is pretty short-term loans, right? Eurocommercial paper is usually denominated in US dollars, and the quality is usually lower than the USCP, so yield is usually higher. Euro interest rate futures contract. So this is futures contract. As you know, futures is structured contract. So it's widely used futures contract for hedging short-term US dollar interest rate risk. In chapter 7, we focused on futures contract on the foreign exchange, right? Futures contracts are traded on many different underlying assets. One particularly important contract is the Euro-dollar interest rate futures traded on where CME Group. So this futures contract is traded in Chicago, CME Group of Exchange, and Singapore. So Singapore is another center, actually. The underlying assets usually are hypothetical. It's not real one. Hypothetical $1,090,000 Euro-dollar deposit. It should be cash settled. The contract trade in March, June, September, December cycle, and the 4 nearest non-cycle month. Okay. The hypothetical delivery date is the 3rd Wednesday of the delivery month. The last day of the trading is the 2 business days prior to the delivery dates. Okay. Delivery of $1 million Euro is not actually made of, so it's hypothetical again. Invested, no, it's only hypothetical. Instead, the final settlement is made through the realizing profit or losses. So you only get the profit loss or losses. And they change the accounts in CME or Singapore exchanges, right? Yeah, so that's typical futures contract trade. So one of the most typical reference interest rate is the LIBOR again. So LIBOR is the London Interbank Offered Rate. This is the most commonly used reference in the world. For example, you use the LIBOR when the bank decides the adjust the mortgage rate. It's just adjustable mortgage rate, ARM. So LIBOR is quite related with our lives too. If you hold the adjusted rate mortgages, it's also related to any adjusted rate loans, credit rate, the credit card loan rate, like a short-term loan rate. If it is floating rate, then LIBOR is usually typical reference rate. Now, this is also referenced in London for euro currency deposit. So there's a LIBOR for euro dollar, euro Canadian dollars, euro yen, and even euros. Okay, euro actually. In other financial center, there's other reference rate used. Means SIBOR, CIBOR, the Singapore, TIBOR, Tokyo. There's a HIBOR in Hong Kong. And again, the Euro Interbank Offered Rate, which is Euribor, is the rate now at which interbank deposit of euro are offered by one primary bank to another in the Eurozone. So Euribor may be used as a reference rate in Eurozone country. But this LIBOR is probably the most famous, popular, commonly used reference rate in the world. All right, so this is it for the second part. We'll do the financial crisis, debt crisis part in the last part of the chapter. So see you in the next part.